First of all, I'd like to thank the organizer for keeping me in the program. I really enjoyed the conference so far. And rarely do I get to present where the earlier paper kinds of gives the setup for what I am trying to do. So it's even better. So let's start with some of the first papers. I think the first paper, what they showed today was markets, the prices are not exactly efficient all across the world. So mispricing exists. So then the question is, as Josh pointed out, if mispricing does exist, then every one of us can trade on it. And if some large arbitrageurs or have enough capital and we trade on it, then the mispricing must stop to exist and the prices must be more efficient. Why is it not the case? And my paper, actually, Josh anticipated whatever I was about to say. So what I mean by liquidity in my paper is kind of price impact. Liquidity is a transaction cost. There are different ways of what we mean by liquidity. One is transaction cost, bid or spread. But most importantly, how much do you move the price when you trade a large amount of stocks? And you also mentioned that market impact varies over time, which is what I call as liquidity varies over time. So essentially what I am trying to do in this paper is provide an explanation as to how variation in liquidity or market impact uh, gives an impediment or a friction which affects arbitrage activity. And consequently, that explains the prevalence of mispricing in certain stocks which have a high variation in underlying liquidity. So quickly to summarize the paper, I will introduce a model where this is not a complicated model, it's a standard model of arbitrage. I just introduce one friction, which is that the market impact changes over time. And then the model predicts that in these stocks where the liquidity changes over time, arbitrageurs will reduce their exposure to these stocks. Compared to absence of this friction, the positions arbitrageurs take is going to be reduced. And we know that for prices to be efficient, we do not need all the investors to be rational. Even if a majority of the market is noise traders, even a few arbitrageurs taking large positions will eliminate mispricing. And this is the channel in which mispricing continues to exist, at least a part of mispricing continues to exist. And another prediction of this model is stocks which have high variation in liquidity. The mispricing will be severe. So I will test the predictions of the model in the empirical section by using the stamp bar U1, U1 mispricing measure, as you pointed out. And I'll use Pharma French factors as a risk adjustment. If time permits, I will say something about how this arbitrage can explain the cross-section of returns and variation in liquidity. So this model is a simple model, and so we have two assets. One is a risk-free asset, and another is a risky asset. And we have three market participants. Index funds are boring, so they don't do much. They just hold a supply of assets. And but you have noise traders whose demand will move the price of the stock. And that would present an arbitrage opportunity, and arbitrageurs would try to correct that mispricing. And I will try to derive what should be the demand of the arbitrageurs in this asset, and I'll show you how that affects the pricing in the stock. So let's come back to what Josh pointed out, like how do you account for variation in market impact? So how I do it is, if X is the amount arbitrager buys in a stock, market impact is the cost that you have to pay. So the arbitrager incurs a cost of psi x, psi being the coefficient of price impact. I modeled that to be linear, following some prior literature. And now I make this psi, which is the market impact, stochastic. I let it vary in time, which is how I capture the elements of the model. and I assume this is going to be a normal distribution. So the good question then is, assuming it is normal implies that psi can be negative. And in some states of the world, then by trading, you are getting a negative market impact. But let's ignore that for a moment. So yeah, now we have modeled stochastic price impact. And look at the profits of the arbitrager. This is the total amount traded in a stock. This is the gross returns in a stock. And this is the effective cost the arbitragers have to pay. And they pay this cost, which is psi and x, because they move the market when they buy the stock. Let's assume it's a purchase. And this is another market impact they have to incur when they're selling the stock. So this is a two-period model. And the reason I am forcing them to sell all their positions in one period ahead is because we know arbitragers do not have unlimited access to capital. So if I'm trying to make a lot of money, just trading using my own wealth is not enough. And most of the arbitragers, like hedge fund, they depend on external capital to engage in investments and trading. And we know that because of this reliance on external funds, whenever they experience an outflows, they will have to close the positions. And here, I am assuming that they incur outflows with a probability of 1. We can make the model richer by assuming the probability is lower than 1, but I believe the implication still holds. So the friction that I introduced, in the absence of frictions, they will capture this much profit. Now, they have to incur market impact, of which this is our variable of interest. What happens when there is a higher variation in market impact? So I'll retold the intuition. We already discussed this. So when I derive the arbitrager's position in the stock, we get it in this form. It appears that it has a lot of terms, but it's not the case. Already we know that in the absence of frictions, this is the demand for a Kara investor. This part captures what we know already. And the term on the top actually captures what your paper account for when you adjust for transaction costs. So when there is transaction cost, you pay two-way costs, it's taken care of. And you already show that there is mispricing even after that. And the primary contribution of this paper is arbitragers will take less position in stocks which have high variation in liquidity. So which is what you anticipated. I hope I am trying to convince you that this is the case. I'll show some empirical results in a bit. And when we look at the pricing implications when I compute the equilibrium, and let me not go into the details here. Quickly, I'll talk about what this Y is. Y is a scenario where the stocks are underpriced. So the noise trader demand is lower. And these are underpriced stocks, so they earn, Y will be positive, and these stocks will earn higher returns. And among underpriced stocks, we can find that the relationship between gross returns and this is positive. So what the model also suggests is among underpriced stocks, the stocks having high variation in liquidity will be the most underpriced. And the relationship would switch. When we look at a section of overpriced stocks, the stocks that is having high variation in liquidity will be overpriced and earn more negative returns. So this is the model. Let's look at the results. Yeah, we need a measure of variation in liquidity now. So there are a lot of different measures of liquidity people have proposed in the literature. So for this paper, I use the standard deviation of monthly turnover, which I have measured data from previous 60 months as the primary measure of variation in liquidity. But we also need mispricing because the model says mispricing will be severe in stocks having high variation in liquidity. For this purpose, we do not use your methodology. We use the Stambo U and U1 methodology. computed from these scores. And in terms of risk adjustment, I use Farmer-French 5-factor model. I use Farmer-French 5-factor model. And so essentially, quickly, a summary of the hypothesis before we look at the results. When we sort stocks based on mispricing, the underpriced stocks will earn more returns as mispricing corrects, so underpricing corrects over time, which means, as you noted, the alpha will be positive, they earn more returns. And when we increase the variation in liquidity among these stocks, then they must earn even higher positive alpha. And that relationship will reverse when we look at the overpriced stocks. So let me go back to, let's finally look at the results. So what I have done is, this is based on US stocks. Each month, I independently sort stocks into quintiles based on the variation in liquidity, which is the turnover volatility in this paper. Also on how mispriced these stocks were. So when we look at when mispricing is low, what it implies is these stocks are underpriced. So in the subsequent month, they will earn higher returns or higher alpha. So typically, that's what we find. We find that they earn higher returns. Overall, let's ignore these two things for a bit. And when we look at high mispricing, these are overvalued stocks, and they tend to earn negative alpha, and that's what we generally find. So, but the model suggests that this underpricing should increase when the variation in liquidity increases. Essentially, that means underpriced stocks must earn even higher returns. And that is what we find. It's not exactly monotonic, but as turnover volatility increases, we find that the alphas increase. So alphas generally increase with turnover volatility among underpriced stocks. And when I form a long-short portfolio of high turnover volatility and low turnover volatility, this is positive, which is what is suggested by the model. If you remember the Y, the relationship between gross returns and this must be positive. And when we look at the high turnover, the overvalued stocks, and when we move across quintiles based on the level of turnover volatility, the alphas decrease, and the highest turnover volatility group is where most of this alpha exists. So overall, these results are consistent with the model's predictions. And I am going to skip a bunch of other, because this is the primary contribution of the paper, highlighting that it's a risk. I have done a bunch of other tests which are mostly supplementary tests, so I'm not going to spend much time. Just to conclude, I think I present a theory. Hopefully, it is convincing to you. As you mentioned, I do agree that variation in market impact is a risk, and arbitrageurs are aware of it. And the reason, the intuition is, they might experience outflows when the liquidity state is low. And if they have to sell all their positions in the low liquidity state, they might push the price even down further. It could lead to fire sale situation, and they'll have to take an even bigger hit on the losses. Because they're averse to this happening, they take less positions, and that results in higher mispricing. Thank you.
We have our discussant, Thank you. While she's setting up, I just want to speculate. Badri, it seems to me the cleanest setting where we could explore your idea is a spot futures arbitrage with early unwind. Okay, so imagine I have begun the arbitrage, but uncertainty about impact cost about my exit will shape my risk-reward calculations about the arbitrage. So volatility, liquidity risk will directly go into efficiency of spot futures arbitrage.
Well, thanks for inviting me here to discuss this interesting paper. From the title of the paper, we know that this paper tries to investigate the relationship between variation in liquidity and costly arbitrage. And after this kind of relationship, the paper tries to solve the puzzle. So I would like to start from the puzzle in the paper. The level of liquidity can predict stock returns like share turnover and dollar trading volume. Given that agents care about the risk associated with variations in liquidity, then the second moment of liquidity should be able to positively predict stock returns. However, in the literature, Caudill et al. In 2001, they document a negative relationship between the stock returns and the variation of dollar trading volume and share turnover. I think this is also the motivation of this paper. Here, I give a quick summary of the findings in the paper. There are two main contributions in the paper. The first one is variation in liquidity can represent the costly arbitrage. The model shows that arbitrageurs limit their exposure with stocks with high variation in liquidity. In the model, it predicts mispricing is severe in stocks with higher variation in liquidity. It means underpriced stocks with high variation in liquidity tend to be more underpriced. Overpriced stocks with higher variation in liquidity tends to be more overpriced. So in the empirical work of this paper, it shows that the turnover volatility and return relationship is negative among overpriced stocks, but positive among underpriced stocks. And then the second contribution of the paper is try to solve the puzzle. Costly arbitrage and arbitrage asymmetry together can explain the negative relationship between variation in liquidity and stock returns. For me, I have several comments on the empirical work for the paper to help improve the paper. First is about the proxies for limits to arbitrage. In the literature, I found that some researchers like Lim and Wei, they list 10 proxies for limits to arbitrage or costly arbitrage, like idiosyncratic volatility, analyst coverage, and stock price bid-ask spread, and Amihood illiquidity measure, and so on. Given that there are several proxies for costly arbitrage or limits to arbitrage, my concern is variation in liquidity is an additional limits to arbitrage factor after accounting for these major proxies. So I may suggest, though the paper has done some robustness tests with the idiosyncratic volatility, I may suggest to do more after control more major proxies and show the advantage of your proxy with others. Yeah. My second comment is about the puzzle in the US. This is a very new paper, and it is accepted in the October IFS paper. It's by Hou, Xue, Zhang. They replicate 452 anomalies in the US market. And they find that the majority of anomalies from trading frictions are not replicated in the US market. This includes the coefficient of variation of share turnover and the variation of dollar trading volume. This is data mining. Here is the result. With the NYSE breakpoint and value-weighted returns, the high-low decile return spread is 0.12 with the t-value of 0.8 H2. We see this is a positive relationship between variation of turnover and stock returns, but insignificant. Also, so my suggestion is my concern is whether the puzzle exists in the US market with a single portfolio analysis and value-weighted returns. In this paper, the author has done the Fama-Macbeth regressions to solve the puzzle, but the Fama-Macbeth OLS regressions may be dominated by the micro-cap firms. So I may suggest to do the single portfolio analysis with value-weighted returns to solve us the puzzle. Here I have some supportive evidence in China's market for the puzzle. I replicate some anomalies in China's A-share market, and I find that the volatility of turnover and dollar trading volume has a negative and significant relationship with stock returns. Here is the result. The high-low decile return spread for volatility of turnover is minus 0.89% per month, and with the significant t-value. So I buy the story in China because China is a market with more severe limits to arbitrage, and the short sales on individual stocks are almost forbidden. Yeah. So arbitrage asymmetry is very strong in China. So my third comment is about the arbitrage asymmetry in the paper. Because they use the costly arbitrage and arbitrage asymmetry together to explain the puzzle. So what is arbitrage asymmetry? So arbitrage asymmetry means that overpriced stocks, taking long positions for stocks is much easier than taking short positions. So overpriced stocks is less easily corrected than underpriced stocks. Therefore, the negative turnover volatility effect is stronger for overpriced stocks than that for underpriced stocks. In this way, we can have the overall turnover volatility and return relationship is negative. So this is the key point to explain the puzzle. However, in the result, empirical result, in the paper, they do the double portfolio analysis with the mispricing scores and the turnover volatility. Here, for overpriced stocks, we see the high-low return spread for turnover volatility is minus 0.79. And for underpriced stocks, it is 0.53. The difference is only 0.26. So this is a marginal difference, I think, yeah. So I think the arbitrage asymmetry in the double portfolio analysis is not strong to show the overall turnover return relationship is negative. Here, for the robustness test in the paper, they use the daily turnover to do the robustness test, and here the magnitude for overpriced stocks is even lower for the underpriced stocks. So arbitrage asymmetry disappears in the robustness test. So I also have some comments about mispricing scores. I know these mispricing scores are well established in the literature. They use 11 return anomalies that survive for the Fama-Friends 3 factors. I think these are earlier literatures, but recently Fama-Friends proposed Fama-Friends 5 factors and 6 factors, and Hou Xuezhang proposed their Q factors and Q5 factors. And these 4 anomalies among these return anomalies, they are priced investment and profitability factors. So I'm a rational asset pricing person. I don't think these 4 anomalies are due to mispricing. So my suggestion is whether it is easy or possible to update the mispricing scores with the Fama-Friends 5 or 6 factors. So my last comment is the micro-cap firms. Why we care about the micro-cap firms? In the result, in the paper, they show small firms tend to have higher turnover volatility, and small firms tend to be overpriced. And we also know that small firms are less easily sorted. So my concern is whether the result hinges importantly on including these small firms. So my suggestion is to do the robustness test after dropping the micro-cap firms. So overall, this is a very interesting paper, and the paper provides a new perspective to link the second moment of liquidity to costly arbitrage, and this is new. And they try to use this to explain the puzzle. So I really enjoy reading the paper, and I learn a lot from it. So my comments is the paper may be potentially improved if more robustness tests are provided. Yeah. Thank you.
Thank you. Yes, please, Larry.
I wanted to add to the comment about small firms. Undoubtedly, the firms with the highest variation in liquidity are the smallest firms. And that doesn't challenge the paper in any way. But I would make the following observation. It's for those small firms that there's not a whole lot of liquidity to begin with. And without that liquidity, informed traders like arbitrageurs can't obtain a profit on their information. And so it would be likely then that those would be the firms for which these relationships are least strong. And so whether it's low liquidity or high volatility of the liquidity or small firms, they're all very closely correlated, but they're all essentially the same story. And it doesn't take anything from the paper, but it helps us understand a little better.
And just adding to that, I would make a distinction between an event of an ordinary fluctuation of liquidity, there's a little higher, little lower, and the catastrophic event from the viewpoint of an arbitrager, which is just a complete collapse of liquidity, at which point you're doing a fire sale. So there's probably a left tail in impact cost for some of these firms, which is really quite frightening for the trader.
I would like to thank all comments.
You need to switch on your mic.
Hello. Yeah. First of all, thanks for all the comments, and I see merits in every comments. I would like to address all of these in the future because most of these I have not done yet. So thanks for pointing this out. Okay. So with respect to Larry's comments, is also related to Fang's comments that I have to check how much of it is coming from small firms, and whether is actually variation in liquidity, or what is the correlation between variation in liquidity and the level of liquidity. I find based on, I did not get time to talk about it, like based on the measures of liquidity I used, it appears that the result survives, but maybe I have to do a better test than what I have done. I did 3 by 3 by 3 sequential sorting, but I have to think about that deeply, which I will definitely do. And yeah, with Fang's comments, great comments, I have to, I was not aware of people coming up with 11 limits to arbitrage already. I was only aware of a few, so I did robustness checks for that, and I'll definitely do for the rest. As far as the comments regarding arbitrage asymmetry is concerned, in the current paper, so initially I tried to make a stronger claims, not only about whether variation liquidity affects arbitrage, but also whether I can say more with respect to how the cross-section of stock returns, the relationship between variation liquidity and the cross-section of stock returns. Now I have toned it down. In fact, if you look at the paper that I have sent it here, I do not make any significant claims about arbitrage asymmetry because the biggest issue is the relationship which was suggested in Chodia et al. 2001 seems to be that when you look at different measures of variation in liquidity, that cross-sectional relationship seems to be flaky, so it doesn't hold when we use different measures. But I have to make it very clear that irrespective of the measures of liquidity I use, the results I presented so far still holds. The only thing which is not holding is how the results I presented extends to the cross-section of expected returns. So I do agree with those comments, and I have to mention that I have toned it down. So the primary contribution of my paper right now remains, as Josh anticipated, we have to be careful about the changes in market impact over time. But thanks to everyone's great comments. Thank you.